Hi, I'm William Dolan, and this is Esquire Advice, where we explain complicated and lucrative real estate and business topics. Remember, we are not forming a lawyer-client relationship by way of this channel. Always consult your local attorney before taking any action. With that said, grab a pencil and a piece of paper and get ready to learn. Welcome everyone to our intermediate level real estate episode on lease purchasing. Before we start, please kindly hit those like and subscribe buttons so we can keep bringing you valuable and profitable content. All right, so lease purchasing is one of the more complicated investing strategies. Lease purchasing is essentially where the seller finances the purchase of the seller's property, but the buyer doesn't take title ownership until the buyer's paid the total purchase price and all the interest that's accrued. It's sometimes referred to as a lease purchase transaction. It's also sometimes called a contract for deed, agreement for deed, installment land sale contract, and conditional sale, depending on what area you're located in. All right, so we're going to tackle this key concept style. We're going to go over the 6 key concepts for lease purchasing. All right, so the first concept is it requires less cash to purchase. So if you're the buyer, you're going to negotiate for the seller to finance most or all the purchase price. So you're going to have a small or possibly even no down payment. Also, you're not going to need to pay closing costs now because you're not taking title ownership now. You're going to take it when you've paid the seller in full. So the closing costs we're talking about there are your transfer taxes, title insurance premiums, title searches, closing fees, recording fees, lender fees, appraisal, all those types of charges. So the second key concept is the seller is financing, so there's no lender. So since the seller's financing, generally loan approval is going to be easier and loan terms are more favorable. So the seller might be a little more lenient with things like credit, debt to income ratio, how long you've been on your job, and those types of items. But look, you always have to be careful about usury. Usury varies state to state. So you really need to reach out to your local attorney and make sure whatever you're doing isn't going to violate the usury laws in your state. There's also some licensed lender requirements, and you want to make sure you're not going to violate those. And those sit at the state and the federal level, so make sure you ask your attorneys about those. The next key concept is typically you're going to be out of landlord-tenant world, at least if you're located in one of those states that has a statute that governs these types of transactions, which we're going to talk about in a moment. Those statutes are typically going to pull you out of landlord-tenant world. Now, why is that important? So once you're out of landlord-tenant world, the tenant can be obligated to do things that the tenant can't in your traditional lease agreement. So you can put all the maintenance and repairs on the tenant, the obligation to pay property taxes, the homeowner's insurance. You can have attorney's fees provisions, which a lot of states won't allow in a residential lease, limitation of liability provisions for the landlord, indemnification provisions, all types of great benefits, at least if you are on the landlord side or the seller side of that deal. Generally, there's no need to foreclose. I know this is going to confuse a lot of people, so let me give you a little bit of context. So at common law, this type of transaction would create an equitable ownership in the buyer-tenant, and the seller would have to go through a foreclosure action to terminate the buyer's rights. So many of these statutes have changed that. So for example, in a state like Delaware, the statute converts the transaction to a landlord-tenant matter after certain events have occurred, and then it allows the seller-landlord to go to the landlord-tenant court and have the buyer-tenant evicted after the conversion. So this is kind of like in Delaware, the best of both worlds. While you're in the lease purchase world, you can have all those special terms. This obviously is a benefit to the seller. And then if there's a default, instead of having to go through the traditional foreclosure process, you can have the tenant evicted, which is a lot easier and quicker. All right, the next key concept is many states have complicated statutes that govern these transactions. So you're going to need to consult a local attorney on these transactions. There's no doubt about that. So the reason for these statutes is there was a lot of abuse. Unfortunately, there were many investors out there putting deal structures together that confused counterparties into agreeing to something that they really didn't understand. When this happens too much, states will enact statutes or courts will adopt legal doctrines to curb the abuse. So here we are. So think of it this way. States have essentially said there's a bunch of these kinds of transactions that are all similar in substance, even if they appear different in form. So we're talking about your lease purchase, agreement for deed, contract for deed, installment land sale, contract, conditional sale, even sometimes a lease option when the investor tries to tinker with the terms a little too much. And the courts have said basically, okay, all of these things, we're going to funnel these down, and all of these similar transactions are going to have to follow the same strict set of rules. So although these statutes are different, sometimes considerably different, most have some important similarities. You not only have to agree to a sales price, but you also have to identify a loan amount, interest rate, term, and payment. So I get asked a lot by clients, but why? This buyer and seller didn't agree to do it that way. Why are we forced to do it this way? So I can't give you the behind the scenes story of every state, but I can for one of these states in which I practice. So I have heard directly from one of the drafters of the bill in one of these states that the particular abuse in this given state was that buyers were telling sellers that they were giving them their purchase price, but then the seller was giving an interest-free loan for 30 years, but without realizing it. So I'm sure some of you are saying, great, now I'm going to get punished for making a good deal, right? Well, let's take a look at a quick example. Let's say an investor agrees to pay the seller his asking price of $100,000, but tells the seller the seller has to finance it, maybe without giving a lot of details, right? So $100,000 is what the investor does, takes $100,000, divides by 360, and comes up with a monthly payment of $277.78. And the seller agrees to it before realizing that these payments seem really low. Look, maybe that's because the seller's elderly. Maybe it's because he only has an 8th grade education. Maybe the investor wasn't all that forthright. Maybe it's because all this just happened so fast, the seller didn't realize it was done before it was too late. In any event, this seller has taken a huge loss because there's been no appreciation of the time value of money. So the time value of money basically says that $1 today is not worth as much tomorrow, certainly not 30 years from now. So to take into account the time value of money, let's do a reverse calculation. Let's take that same $277.78 a month payment over 30 years, but this time let's use 5% interest instead of 0, and reverse calculate to figure out what the loan amount, which in this case is also the purchase price. Remember, there was a $100,000 purchase price and $100,000 was financed. Unfortunately, there was no down payment. So what do we get? We get a $52,000 purchase price loan amount. So that means this seller sold the property for 48% less, basically half of what he thought he was selling it for. Those are the kind of issues that the courts and legislators are trying to avoid. Look, let's face it, there's a difference between negotiating a good deal and taking advantage of someone who doesn't understand what's going on. The other common trait that I've seen in these statutes is there's generally a refund to the buyer of certain amounts if the buyer defaults. Now, the trigger for that refund to the buyer and the formula to calculate the refund tend to be very complicated. And I know because usually when I'm advising in the states in which I practice, this part of my discussion with clients is usually about 10 minutes long. So unfortunately, we can't really get into the details of that here in this video. So the next issue that we're gonna tackle is title clear. So if you're the buyer, there's two related but discrete issues here. One is whether title to the property is clear at the time you enter into your lease purchase agreement. And then the second is making sure that it remains clear from the time you enter into that lease purchase agreement until record ownership is transferred to you. So here you're going to need to do a title search and have a lawyer go on the hook and tell you that that title search looks okay. Then if you're the buyer, you're going to want to record the agreement or a memorandum. That gets a little bit trickier though. You record the agreement in the applicable recorder's office. So you're also going to want to include a provision that prohibits the seller from doing mortgage loans, at least if you're on the buyer side, right? So what you're trying to avoid here is if you're going to pay for the property over time, as you get farther and farther into your loan, your balance to the seller is going to go down. And what you don't want is you've paid your balance to the seller down and then the seller goes out at some point later and gets a really big loan against that property, and all of a sudden, when you're ready to get the title transferred to you, the seller can't do it because the seller has a big mortgage on the property. All right, so now if you're on the seller side, you don't want that agreement to be recorded because you want the flexibility to be able to refinance. And if the buyer defaults, you don't want to have to get the buyer to sign a release form to then have it recorded in the recorder's office, right? What if the buyer goes AWOL and just takes off? You could have this cloud on your title without getting the buyer to sign a release. Now, there might be some workarounds with it, but this is where you really need to work with your local attorney to make sure you're protected, but you also can get your deal done. So many investors will ask, should I just do a lease option then if this is going to be too difficult? And that is another route that you can take. But just remember, you're going to be in the landlord-tenant world, which means the rights and restrictions that are involved in landlord-tenant law are going to be applicable. And there's also going to be no credit toward the purchase price for payments, which makes the financing harder. As many of you know, usually the lease purchase transaction is used to try and make the future financing better. So oftentimes there's a term in these lease purchase agreements where the buyer has to refinance and pay the seller off. Usually it's described as a balloon type transaction where maybe in 2 years, 3 years, 5 years, the buyer has to go out and get regular financing and pay the seller off. And they want part of those payments to be applied toward that purchase price so whoever that buyer is has to come up with less money at the time they purchase. So remember, you're not going to be able to do that with a lease option. I would also recommend whatever you do, whether it's a lease purchase or whether it's a lease option, that you talk to a local mortgage professional to make sure that they're going to credit either those parts of the payments or parts of the option consideration, whatever it is, toward the purchase price, if that's an important part of your deal for the buyer. Now remember, do not ask the mortgage professional to structure the deal for you. They're not lawyers. They're not going to understand what the laws are. They don't know how to draft documents, and you'd be asking them to engage in the unauthorized practice of law, which probably isn't good for you or them. But it is important to know, for example, if you're going to use that lease option strategy, if you want that option premium to be credited toward the purchase price, it would be worthwhile to ask, is your underwriter going to accept that? You need to make sure your lawyer drafts that in the documents, right, to make sure that if the buyer exercises the option, that the option premium is credited toward the purchase price. That's the lawyer's part. But then you need to go to your banker to make sure, is the bank going to credit that? Because if the answer is no, hey, Fannie, Freddie, FHA won't allow that, then you need to go back to the drawing board and make sure your deal is still going to work the way you need it to work. So I hope these key concepts are going to help you with your lease purchase deals. And don't forget, we have episodes on many real estate and business topics coming out weekly. So kindly subscribe and hit the notification bell so we can get this information over to you. And hit the like button so we can keep creating this free content. Thanks for watching, and I'll see you next time.